Welcome to this explainer. Right now, there's this widespread, almost palpable anxiety hanging over the market, right? Every single time one of today's tech giants, the NVIDIAs, Microsofts, Alphabets, Amazons, or Metas of the world, posts just another monster earnings number, this wave of panic seems to follow right behind it. You see it completely dominating financial Twitter, taking over CNBC panels, and filling up Reddit threads. As a focused learner, you're probably trying to cut through all that noise to figure out what's actually happening beneath the surface. Well, today we're going to do exactly that. We're breaking down the fundamentals driving these mega-cap tech stocks to see what the numbers are really telling us.
So, the big, overarching question everyone is asking is pretty simple. Are we living through the next 2000? Is this whole AI stock boom just a massive, fragile bubble that's about to burst, exactly like the dot-com mania a quarter century ago? It's a really visceral fear. And honestly, it is completely understandable. Human psychology is just hardwired to look for historical patterns. When we see charts going parabolic, our gut instinct is to brace for impact. But today, we're answering that question with hard data, not just vibes. And that market fear? It's rooted in a terrifying reality from our past. Think about this. When the music finally stopped back in the early 2000s, the Nasdaq crashed roughly 80% over just 2.5 years, an 80% drop. It was absolutely brutal. Now, the internet itself was incredibly real, and obviously it was transformative. Companies like Amazon survived a gut-wrenching 94% drawdown to become one of the greatest compounders in history. So the technology ultimately won out, but the stocks, they did not. Why? Simply because stock prices had completely and utterly detached from the actual cash-generating reality of the businesses.
So, to get to the bottom of this, here is our agenda for today. First, we'll examine the dot-com bubble ghost. Second, we'll dive into why today is different. Third, sizing the AI opportunity. Fourth, dividends and capital returns. And finally, number 5, risks and investment strategy.
All right, let's jump right into section 1, the dot-com bubble ghost, and look at what actually happened when the music stopped.
To really understand the ghost of that era, we have to rewind to March 2000. The Nasdaq Composite peaked near 5,048. And get this, it had a forward PE ratio hitting an astonishing 60 times earnings. Cisco even briefly became the most valuable company in the entire world. The market was basically pricing in centuries of flawless growth. But here's the most shocking statistic from that era, and honestly, it tells you everything you need to know. 14%. Only 14% of dot-com companies were actually profitable at the absolute peak of the mania. The highest-flying names literally had little to zero profits. You had these companies like Pets.com and TheGlobe.com trading on eyeballs and network effects while bringing in completely negligible revenue. They were bleeding cash just to keep the lights on. It was this crazy environment of widespread unprofitability across the board.
Now let's move to section 2, why today is different, focusing on profitability, scale, and real moats.
Fast forward to today, and the Magnificent Seven, along with related AI leaders, absolutely dominate the Nasdaq 100 and a massive slice of the S&P 500. NVIDIA alone has crossed a $5 trillion market cap at times. And you've got Alphabet, Apple, Microsoft, and Amazon all sitting comfortably in the multi-trillion-dollar club. Now, yes, concentration risk is definitely high, but when we actually look under the hood, a stark contrast emerges. Back in 2000, investors were buying what you'd call concept stocks, businesses burning cash with zero clear path to profitability. Today, we're investing in infrastructure leaders. These companies are printing massive free cash flow. Take NVIDIA, for instance. They've delivered net margins around 50% and are looking at fiscal 2026 revenue in the neighborhood of $216 billion. Microsoft, Alphabet, Meta, and Amazon, they're generating tens of billions in annual free cash flow. These definitely aren't concept stocks. They own the critical cloud and GPU ecosystems, and they are monetizing AI at an immense scale right now.
Let's look at the actual valuation math here to really put this into perspective. At the 2000 tech peak, the top names were trading at roughly 70 times forward earnings. And frankly, many were priced on infinite multiples because, well, they had zero sales. Now look at today's landscape. Alphabet is sitting near 17 times trailing earnings, Meta and Amazon are in the low to mid-20s, Microsoft is around 27 times, and NVIDIA is around 33 times trailing. The 2026 hyperscaler average is roughly in the mid-20s for forward PE. So are these valuations elevated? Yeah, for sure. But paying mid-20s multiples for companies backed by absolute fortress balance sheets and double-digit earnings growth is vastly, profoundly different from the speculative insanity we saw in 2000.
Which brings us right to section 3, sizing the AI opportunity and exploring this multi-trillion-dollar horizon.
The numbers on the horizon are just staggering. Citigroup has raised its global AI market outlook to more than $4.2 trillion by 2030, with enterprise AI serving as a major driver. Other analysts are projecting the broader AI market climbing well into the high trillions, with compound annual growth rates ranging anywhere from the high teens to over 30%. I mean, $4.2 trillion. That perfectly illustrates the sheer mind-boggling size of the prize these companies are aggressively chasing.
So what specifically is expanding this total addressable market at such breakneck speed? Well, we're seeing massive drivers like agentic AI, sovereign AI, surging inference workloads, and deeply embedded industry-specific applications. Demand for AI compute is actually continuing to outstrip supply in many periods. The hyperscalers are literally spending hundreds of billions of dollars on data centers, chips, and power just to meet this demand. But here's the absolute most crucial distinction from 1999. They are funding these massive infrastructure buildouts largely with their own operating cash flows. They aren't out there issuing tons of equity or taking on dangerous leverage to build the future. They are paying for it in cold, hard cash.
Let's pivot over to Section 4, Dividends and Capital Returns, and see why having skin in the game matters so much.
There is this quiet but absolutely critical evolution that really separates today's giants from historical bubbles. They are actively returning capital to shareholders. Let's break down how these compounding machines actually treat their excess capital. Microsoft is a super reliable dividend grower, yielding around 0.7 to 0.75%, and they pair that with aggressive buybacks. Apple continues its substantial dividend along with a, frankly, enormous share repurchase program. Alphabet and Meta actually initiated dividends in 2024, yielding in the 0.2 to 0.4% range. NVIDIA pays a small dividend, under 0.3%, but that's paired with explosive earnings growth. Amazon is kind of the exception here, remaining totally focused on pure reinvestment. But the crucial takeaway is this. These companies are funding high-return AI investments while simultaneously returning excess capital. That combination, real growth plus rising capital returns, is a far healthier dynamic than the speculative story stocks of the past.
Finally, let's wrap things up with Section 5, Risks and Investment Strategy, and talk about navigating the volatility.
As focused learners, we always have to remain grounded and clear-eyed about structural and macro risks. So, what could go wrong? Well, we could absolutely see a slower than expected monetization of AI. We're also definitely seeing increasing regulatory pressure and antitrust scrutiny. Then there are the very real, physical energy and power constraints for these massive data centers. And of course, macroeconomic shocks could lead to pure valuation compression if risk appetite suddenly fades in the market. Now, while permanent capital impairment for true industry leaders is pretty unlikely, a 20 to 40% stock correction is always a very real possibility in a risk-off environment. Bubbles are usually only diagnosed in hindsight, right? So we must always respect the risks.
Because of those very real risks, here is a sensible step-by-step AI investment approach. Step 1. Position sizing. You really need to understand your exposure, especially since index investors already have a super heavy concentration in these specific names. Step 2. Dollar cost averaging. Do not try to time the market perfectly. It rarely works. And step 3. Maintain a multi-year horizon. This is absolutely not a buy today, sell next quarter kind of trade. By building a diversified basket of quality US AI leaders, you don't have to bet the farm on a single name. You can spread your single stock risk while still maintaining vital exposure to what is arguably the biggest secular megatrend of our time.
To wrap this all up, the data clearly points to a foundational economic shift, not a 2000-style bubble. Yes, valuations are high, but they are supported by real, massive cash flows, wide moats, and huge enterprise demand. The digitization and automation of the global economy are just accelerating, and U.S. technology leaders are firmly in the driver's seat. The future is quite literally being built in American data centers and software platforms right now. The big question is, are you ready to own a piece of it? I really want to hear from you. Drop a comment below with the AI stock you're most constructive on, or let me know your biggest worry about the market right now. Thank you so much for joining me for this explainer. Keep learning, and I'll see you in the next one.